Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Parmar.
Welcome to the crypto section of Wealth Matters podcast. So I hope when you listen to this, hope you had a great weekend. Hope this fire and smoke goes away in California, as well as, we see the flood residing in New Orleans all the way to Northeast, because we have been going through a lot in last couple of years. Of course, the Delta variant as well here in US and other parts of the world. So I'm hoping all of us get vaccinated and move on from this. But I've been talking about how to make your crypto work for a while, like how to get free Bitcoin, how to do staking and earn Bitcoin, and how to put store Bitcoin and other cryptocurrencies in platforms like Gemini to Voyager, as well as BlockFi, which is what I use personally to earn interest on your cryptos, right? So all of us, or at least people who believe in crypto, there are always traders where they want to buy low, sell high, and continuously do that. I also play with, like, I would say 10% of my crypto portfolio, but most of my 90% cryptos are hodling, right? I'm holding on for my dear life. I'm not going to sell them. So while I'm waiting, why shouldn't I make more money, right? It's like, dividend earning stocks. It's like real estate where you're getting cash flow from the rental income. So I want to continue to figure out different ways. Of course, the one way I spoke about was the first one, earning totally free cryptocurrencies through playing games, as well as what did we speak about was the airdrop method, faucet method, and then of course using interest earning and staking. I want to talk about liquidity pools today. So what are liquidity pools? So liquidity pool is a smart contract that allows a user to deposit assets into a pool managed by the smart contract. The pool is used for liquidity to power the swapping ability of a DEX, decentralized exchanges like Uniswap, PancakeSwap, 1inch, Matcha, AppSwap. There are a lot of those platforms, QuickSwap as well. Investors are encouraged to deposit into liquidity pools because they earn revenue from the swaps that happen on the DEX platform. So what I mean by that is, let's say you go to Uniswap app and you want to buy a token, and we'll talk about Fox token today, FOX. I'm not recommending, but I'm making pretty good money with it, so I'm going to continue to do that. But once let's say you have Ethereum, of course you need Ethereum or any other coin, which is ERC20 based coin, to buy some of those tokens. Once you have Ethereum, you can when you go to Uniswap or QuickSwap and you want to buy a Fox token, then you will be basically saying, oh, I want to swap 0.5 Ethereum or whatever, 0.1 Ethereum into some Fox tokens. Where does this decentralized exchange get those tokens from? See, like centralized exchanges like Coinbase, etc., they are more like a trading platform. They have always the buy and sell side. The decentralized exchanges don't own these tokens, so they always need people like you and I to lock their tokens in their platform so people can come and use those tokens to swap, right? So once you lock your tokens in this particular platform, they pay you the fees. So basically, whatever fees they earn, they share those fees with investors, right? So again, simple term, liquidity pool is where basically you'll have to put two tokens together, right? So let's say in our case, we were swapping Ethereum to Fox. So of course, Ethereum to Fox has a good liquidity or demand. Then the Uniswap or any other DEX, or it could be PancakeSwap, they would want you to hold both of them together in that liquidity pool. And by doing that, now they have the pool to support anyone who wants to swap their coins. So some of the benefits of liquidity providing, one, of course, is earning fees. So right, a pool with a popular token pair can have high volume, which leads to higher fees. Like on Uniswap, each trade is charged a 0.3% protocol fee at is split evenly among the liquidity providers in the pool according to what share of the pool they own. High volume means more trading, which in turn generates more revenue for the pool. Earning tokens from farming reward. This is a new trend in DeFi that has allowed many projects to distribute that token to the concept of liquidity mining. In exchange for locking some of your token assets on a given platform, the platform can reward you for your participation in the form of farming reward. So this is another way you can generate money, right, or earn tokens. Airdrops, the third one. Sometimes a project will decide to retroactively reward users who have staked in certain pools with something called an airdrop, and that's exactly how I got my Fox token, because I had used that trading platform which is still called Shapeshift. So when I used it, after a while, when they decided to become decentralized, they just airdropped some tokens for me, and then I got the free tokens. So I said, okay, I'll just go ahead and provide liquidity. A couple of disadvantages of liquidity providing or liquidity pool is you have to be very clear. One is impermanent loss. So the scenario for liquidity pool holder is that there is no much large swing to the downside or the upside for the pool you are providing liquidity to, right? In our case, ETH to Fox, or I'm also providing liquidity to using BNB, Binance Coin, to my Candela token CLA. In this case, let's say, given that most pools base asset is Ethereum or BNB, you have to consider the price movement of Ethereum or BNB into your risk assessment. So what will happen? Let's say you are locking or providing liquidity to Ethereum and Fox, and you are generating Fox token, but let's say Ethereum price goes through the roof. Now you are stuck with, you could have sold those Ethereum, or you could have bought more. Instead, you are stuck with Fox, which hasn't gone up while Ethereum went up significantly, right? Rug pull. So rug pull can also happen a lot. There are a lot of projects which we are seeing. What happens is that sometimes the stake or the liquidity pool you are providing, someone will come in and hack that project, or there are a lot of rug pull scenarios. So how do you prevent being rug pull? The easiest way is to avoid sketchy projects that might engage in this activity, to use ranking sites that list projects that have been examined by professionals, right? So focus on great projects, great tokens. So and still that can happen, but at least you would have done your due diligence. So I'm gonna go ahead and share my screen. So if you are listening to this on Apple Podcasts, I'm sorry about that. You're not able to see this, but anyone who is watching the video on YouTube, I highly recommend going through this as well. So I'm gonna share my screen and we'll get started. So as I mentioned, I am sharing my screen right now. Actually, I was having some difficulty, so I'm just gonna go ahead and share. And I'm actually also going to go to Uniswap as well, so that you guys can see what I'm talking about. So Uniswap or QuickSwap. So here, let's say I want to buy Fox token or any other tokens. I'm going to say that I'm going to use some of my Ethereum, let's say 0.1 Ethereum, and it will calculate how many Fox tokens would be available for me to buy. Once I decide, I can click on swap, confirm swap, and then make sure that it will open up the MetaMask window. So make sure you confirm the transaction. Of course, the fees are pretty high, $135 right now to do the swap. I wouldn't do this, so I'm gonna reject it. But if you are okay, you can confirm. Once it's done, you'll be able to see those Fox tokens in your MetaMask account. So you can go, for me, I'm gonna go all the way down, and I can see I have this many Fox tokens, right? And then once I have those tokens, I can create a liquidity pool, basically by going to the Fox website, because I'm not able to remember if I have the liquidity pool in the Uniswap. So I'm gonna go ahead and pretty much create the liquidity pool here. So if you click manage liquidity, you can add liquidity saying that, okay, this is my balance Fox token, and I want to provide liquidity to this pool, right? So let's say, again, once I do that, I'm going to click on supply. It will ask me to confirm the transaction on MetaMask. The fees are so high that it won't be worth it to stake. So I'm going to reject. But once you are ready, you can click on confirm, because now the Ethereum gas fees are ridiculously high. So once you are confirmed, you can click on supply. And that means you are now providing liquidity to this pool. Once you have provided liquidity, you also need to click on stake button, because now you want to stake that liquidity. You created the liquidity pool by adding your Ethereum and Fox token into the network. So they are now together. Now you need to then click on and provides liquidity to this pool by clicking on staking, right? So that's what I'm doing. Once you can start staking, and once you are done, you can unstake your coins and take them back in your MetaMask or Trust wallet or whichever wallet. But as you can see here, the current APR is 146%. When I started, it was close to 300%. So by providing liquidity worth of, I think, close to $1,900, I have recently generated, I would say in a month, $33. So if this happens, if this continues, I can basically double my money. Also, while the coin values are going up. So this is just on top of all the rewards or all the appreciation. So this is what liquidity pool is. Let me know what you think. Please like and subscribe to YouTube channel, as well as please like, share, subscribe the Apple Podcast. Again, I think this is another way for you to, while you are holding, for you to generate some passive income. And this is awesome because I've been generating a lot of Fox tokens. So I can't wait to continue this, wait for it to go up. And if the time comes, I will get out. But again, right now is not the right time because it still keeps going up. And this is a good way for you to buy basically the coins you love and then provide liquidity again. But be careful because, as I said, if you don't do your research, you could also lose money in liquidity pool as well. So thank you again for watching. Have a great day.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!